I wanted to start today's webinar by acknowledging the traditional owners of country throughout Australia. I'm joining you today from the lands of the Wurundjeri people of the Kulin Nation and pay my respects to elders past and present. I also wanted to acknowledge and pay respects to elders of the lands where you are all dialing in today. I'm James Biggins from Channel Capital, and today I'm joined by Matt Tominc and Casey Taylor from Conscious Investment Management. In today's webinar, we'll be covering the following topics: introduction to Conscious Investment Management, Conscious Investment Management Fund Update, information on the new Social Housing Fund, followed by Q&A. As always, please submit your questions throughout the webinar, and we'll address them at the end. Now, I might start with Matt and Casey. Welcome. I might just hand it over to you to start the presentation today. So thanks.
Great, thanks, James, and thanks everyone for joining today's webinar. As James mentioned, today we're going to run through, many people know SIM already, but we'll kick off by running through an introduction to SIM. We'll then give an update to the SIM Impact Fund, which many people are investors in, or your clients are investors in, specifically running through the current portfolio composition, what returns have been, and the outlook and strategy. And then we'll touch on at the end an overview of our new fund, the SIM Social Housing Fund too. Plan to keep today to about 20 to 25 minutes of presenting, so relatively punchy, but leaving plenty of time for questions at the end. Please ask them in the chat box or send them through after to either us or your Channel Capital representative. So in terms of, as mentioned, many people on this webinar are familiar with Conscious Investment Management, and thank you for your ongoing support of everything we've done. For those that aren't, in a couple of minutes, a quick model of Conscious Investment Management and what we do is that we're a private markets dedicated impact investment fund manager operating across 3 impact themes: environment and climate, health and education, and social infrastructure. All of our investments impact one of these themes and look to address challenges in one of these areas. Specifically, we didn't pick these at random, but we picked these themes because they're areas of social and environmental need that are amenable to profit-seeking capital coming in and looking to make a difference. There are some areas of social and environmental need which just isn't amenable to profit-seeking capital, and that's fine, but these are. Once we've defined those themes, we then define subsectors we focus, the areas with relatively high risk-adjusted financial returns and impact. So they're examples of those are distributed renewables, specialist disability accommodation, social housing, and social impact bonds. And once we've defined those areas, our job at Conscious Invest is the same as every other private markets manager. It's about turning over rocks and finding investment opportunities that others don't find or aren't looking at to identify the best investments. Specifically in impact investing, it's also about having additionality. So funding something that wouldn't otherwise happen, putting more social housing into the ground that wouldn't otherwise exist. And the way we do that is by working with these groups, these logos we have on the page. We call them our impact partners, and they're real partners of ours. They're typically not-for-profit groups with deep lived experience in a particular area. They're groups that help us source investment opportunities, do due diligence on the investment opportunities because they understand the sectors and beneficiaries, and then manage assets once we make an investment. The next slide covers SIM broadly, including a few awards and certifications. We've got a few key shout-outs is last year, Conscious Investment Management was the winner of the Best Asset Manager Award in Australia for 2022 at the Impact Investing Awards. Has been certified by RIA, the Responsible Investment Association of Australasia, as a dedicated impact investment manager, and the fund is now a certified fund as well. A quick update on impact since inception. So these numbers that you see on the page are the impact that SIM funds and you and your clients have had since inception of SIM to the 30th of June 2022. We'll be updating these numbers in the next few months as part of the release of our new impact report, which will come out as at 30 June this year. And specifically also, we're going to focus this year on sending out a bunch more impact reporting content. That'll include video content, things like site visit, virtual site visits, etc. Recognizing that you as investors and your clients have enabled all of this impact, and we need to be communicating that to you. So if you do have any ideas on things you'd like to see in terms of impact reporting or content, please let us or Channel Capital know, and we can make sure we build that in as we go through that over the next few months. Some of the key highlights from from our latest round of impact reporting. To call out a few numbers on this page included the fact that we've now financed so many distributed solar systems that it's the equivalent of planting 300,000 trees and leaving them in the ground for 10 years. We've supported around 100 families, or just over 100 families, across a few various social impact bonds, and financed 260 social and affordable housing dwellings in Melbourne. And those dwellings have provided housing to around 400 people. And we'll come back to that in a moment and touch on that in more detail. Now, turning specifically to the Impact Fund, which is the Conscious Investment Management Impact Fund, which is the subject of today's webinar. The Impact Fund now has around $157 million in net asset value, which is just over 50% of Conscious Investment Management total funds under management. The remainder being a couple of special purpose vehicles in disability accommodation and social housing. Within the Impact Fund, the majority of that NAV is dedicated to housing related investments. So as at the 31st of March, 36% was in social and affordable housing apartments around Melbourne, 15% in specialist disability accommodation, and that's nationwide, 16% in distributed renewables or rooftop solar, and the remainder in both social impact bonds, seed assets, and cash. And that cash balance is really important, where the cash balance is earmarked for future investments, which are sort of very financially attractive investments. It's important we keep cash, so we're cash good and we can win the best investments. And we expect to have that deployed by the end of the year, subject to a few things going our way on those investments, but it's earmarked for those. And that's really important to make sure we're giving a diversified set of investments, but also the highest quality impact investments. Down the right-hand side of this page, you can see some photos of assets financed by the fund. At the top, specifically, that there's a picture of an apartment building. In this apartment building, which is in the western suburbs of Melbourne, we finance social and affordable housing apartments. I think there's 15 in that building, which is super high quality. You sort of can't tell it from the picture, but it's 2 towers, so they're dispersed across. The middle picture is an apartment building, also in Melbourne. For those that are familiar with Melbourne, that's the bike trail, just the main Yarra Trail, just near the Yarra River. And those apartments are looking onto that trail. There's disability accommodation apartments in there, 10 of those plus one for a carer. And then the picture down the bottom is a solar installation onto the roofs of the Clifford Gardens shopping centre in Toowoomba, which is now providing green power to the majority of that shopping centre, which is really attractive. Now that's the current asset allocation of the fund. This slide goes through that same information, but presents it a slightly different way, and specifically presents it based on what we look to do in the long term out of the impact fund. There's a bit of colour and movement on this slide, but the way to interpret it is that the brown circles represent the long run target portfolio allocation, and the grey circles represent the portfolio allocation today. So where grey circles are bigger than brown circles, that means we're overweight. So there's more in the grey. And when grey circles are smaller than brown circles, that means that we're underweight that particular area. And what comes through visually in this chart is that the portfolio is biased towards more defensive, so low risk, low returning investments relative to the long run target. And people recall that the fund targets 7 to 11% over the long term. There's really 2 reasons for this. The first is portfolio positioning in a challenging market environment. We're really conscious as an investment team and as an investment committee of the fund that the fund raised the majority of its capital during late 2020 and over 2021. And they were periods characterized by incredible, obviously, very low interest rates and heightened real asset valuations. And we saw this playing out in the assets that we were coming across. Obviously, given our focus on these sectors, we'd see, say, maybe not every, but many specialist disability accommodation, the majority of specialist disability accommodation investments in Australia come across our desk or land in our inbox. And over the last couple of years, it has been the case that for a lot of those, they're being financed on rates of return that just didn't make sense given the level of risk being taken. And I think that's something that is now well understood given that sort of hot real assets environment over the last few years. In that environment, we made a really deliberate decision to bias the portfolio towards more conservative investments that we're going to protect returns in a more challenging environment and give our investors a smooth and stable investment experience, which we're confident and conscious is the reason that many of you and your clients join us. So that's the first reason, a deliberate decision to bias the portfolio in this way, in an environment to protect returns in the downside. And we've seen that play out. So on the next slide, we'll run through returns and how they've performed. The second reason is really the ability to be opportunistic, which is what an impact investor should do best. Over the next 12 to 18 months, our job at Conscious Invest is going to be to reweight this portfolio towards its long run targets and use the cash balance of the fund to make sure we're doing that to meet long run targets. And being capitalized and having a good period over the last 12 months really puts us in the right position to do that. So at the impact fund being a diversified impact fund and the first of its kind, there really is no fixed benchmark for the fund. What we can do is look to the underlying asset classes for examples of how the market's moving. So in the fund over the last 12 months returned positive 3.6% prior to any, which is a net number prior to any specific rebates. And that can compare to a couple of the subsectors of the fund. So we know that an index of Melbourne apartment prices over the last 12 months was down at least 5.5% based on CoreLogic data, a bit more and using other data sources. Well, because we get independent valuations done on all our assets, disability accommodation cap rates were down sort of 8% plus in some cases. So we're really proud of performance of the fund and specifically the portfolio construction that protected returns on this basis. We've actually just had, we have an independent valuation policy at Conscious Invest and have now had the majority of the funds, I think apart from a couple of small properties, independently revalued and they flowed in over the last quarter. So we know we can be confident in the NAV and also have good pricing and transparency in what we do because it's residential property, so there is good liquidity in the market, good things for valuers to look at. So that's how returns are going at the moment. We're still confident the fund's going to meet its long-term return targets of 7 to 11%. We're really confident in the assets and know that once the market stabilizes, we're well positioned to grow. Now, as mentioned, 36% of the fund is currently in our Victorian social housing investment. So it's worth doing a deep dive on that, and I'll hand over to my colleague Casey to do that.
Awesome. Thanks, Matt. And hi, everyone. It's great to be here with you. So as Matt mentioned, the fund's got a large allocation to our social housing investment in Victoria, and we thought it'd be useful to provide a more detailed update on that asset today. So to recap, in 2021, we signed an investment in partnership with a community housing provider, Housing First, and the Victorian government to acquire up to 307 new social and affordable housing apartments in Melbourne. So over the last 18 months, we've contracted on 260 apartments across 18 buildings. All of those properties have now successfully settled and been leased up to tenants and are now housing around 400 people. There is a single vacancy across the portfolio, and while investors don't wear occupancy risk in this investment, it is an indicator of really strong demand for social housing properties and the quality of the portfolio. As I said, the Victorian government has funded us to acquire up to 307 apartments, and we're at 260 currently. So we are continuing to source and diligence additional properties to round out that portfolio, but remaining very disciplined in the current market to ensure we're only acquiring properties that we believe will be additive to returns. So to touch on returns to date, the investment has still been in the ramp-up phase over the last couple of quarters. However, it's now well on track towards stabilised targets. As of this month, all properties are now leased up, and we'll start to see income increase over the next couple of quarters, and that's being supported by capital growth as well. So as Matt mentioned, our valuation policy calls for independent revals annually, and in line with that policy, 13 buildings in this investment were revalued during the quarter, representing just under 170 apartments. Those valuations came in at a valuation uplift of 3.9% above cost, which is an outcome that we're really pleased with, given the broader decline in housing and apartments pricing specifically in Melbourne that we've seen over that same period. Perhaps the last thing to touch on, and importantly, is impact measurement and the impact that this investment's having. So we're really aware that social housing is an emerging asset class, and at CM we're really focused on building the evidence base for what best practice looks like, particularly when private capital has come into social housing for the first time, like it has in this investment. And we're really keen to share those learnings broadly. And so to support that, last year, we co-developed an impact measurement survey alongside Housing First and their tenants and an independent consultant. And we've included a summary of the results from the first year's survey in the fund's March quarterly report. There's some really interesting data in there around tenant cohort characteristics and also insights into how tenants are feeling in managing in their new homes, which in summary is really positive across a range of themes. So I'd encourage you to give it a read if you're interested, and we can share further information on that piece of work as well. So that's an update on the current portfolio and the Victorian asset specifically. However, looking forward, we'd love to touch on the fund's pipeline briefly. So in summary, the pipeline is the largest that it's ever been. We've got pipeline across all three of our target impact themes. On this slide, you'll see we've included investments that are assigned and exclusive, and these total around $110 million. So as you can see on the slide here, we're continuing to secure new distributed rooftop solar assets on large commercial and industrial buildings. We're also continuing to support specialist disability accommodation alongside summer housing, and we're also in the background forming relationships and investments with new STA providers. We've won a large social housing investment in New South Wales, which I'll touch on in more detail in the next slide. And lastly, we're working with a youth-focused housing provider in Melbourne to support young people access the housing market. And that's a smaller but really high impact investment and does have a path to scale. So all of these 4 investments are targeting financial close this calendar year. And beyond these 4 investments, we do have a much larger pipeline that's not on this slide that's currently progressing through our investment process. In particular, we wanted to call out the large social infrastructure investment that Matt mentioned. So that is our large public housing renewal development that we're in a competitive government process on in Victoria. We have been building the cash balance of the fund in order to finance this project. And if we're successful in that bid, we do expect it to deplete the cash balance of the fund and allow us to open the fund to new investor commitments next quarter. And so finally, from me, we wanted to provide some more colour on the large social housing asset that we've won in New South Wales. We're super excited to have recently announced this alongside our counterparties, who are Bridge Housing, a community housing provider, and New South Wales Government. What's great about this investment from our perspective is that it's effectively a replica of the Victorian social housing investment. And so we really are proving up the scalability and replicability of that model. And we've got great experience and essentially a blueprint for how to execute on this investment successfully. So as I mentioned, we're working with Bridge Housing as our impact partner here. Bridge are one of New South Wales' largest community housing providers with just under 4,000 properties under management. And particularly relevant to this investment, Bridge is the largest recipient of funding under a New South Wales government program called the Community Housing Leasing Program. And through our proposed investment with Bridge, we've been able to structure an investment around this funding stream, under which we'll acquire up to 90 properties across Sydney. And similar to the transaction in Victoria, we'll head lease those properties to Bridge Housing for a period of 10 years to support social housing tenants. And income here comes from both a tenant contribution to rent and then a rental subsidy from government that's contracted for 10 years that supports effectively a rental subsidy to top up rent from what tenants are able to contribute to market rates. So in terms of where we're at here, we're in the final stages of legal documentation and expect to be out in market procuring properties towards the back end of the year. As I said, we're really excited about this investment. We think it will continue to demonstrate that social housing is an attractive and high impact and, of course, much needed asset class for investors to support. And from our perspective, with your support and capital, we've been able to be a first mover into social housing, and we're now seeing a lot more opportunity come our way as a result of that. And so I'll pass back to Matt now to talk about a new dedicated social housing fund that we're currently launching to complement the impact fund. Thanks, Matt.
Great. Thanks, Casey. We've touched a bit on social housing today, and the reason for that is twofold. The first is it's obviously a huge area of social need in Australia. The left-hand side of this slide really summarises the key factors that you need to break the cycle of social disadvantage, one of which is stable and safe housing. And access to that stable and safe housing, which won't be a surprise to anyone based on everything we've been reading in the reports in the newspapers over the last few years, access to that housing has declined. We're seeing rates of people experiencing homelessness going up, supply coming down in a bunch of housing markets, and rental increases. The second reason that we focus on this at CIM is a more impact investment focused lens, and that is we spend a lot of time thinking about how our capital can not just have a direct consequence, so a direct impact, but also catalyse things more broadly. And we are conscious that off the back of funding, what we think is Australia's first privately funded social housing last year in Victoria, which Casey mentioned, we've learned a bunch of lessons, and we are an early mover, which means that it's almost incumbent on us, it's almost vocational to show that model works at scale and can work interstate, but also show what good looks like. So as this asset class develops, impact investment has played a role in defined what good looks like and what funds can look like in the space in a way that's very tenant focused, as well as earning a financial return. We'll touch on the fund in a moment and run through this relatively quickly, but most importantly, perhaps, is focusing on definitions before we get there. People often talk about social and affordable housing together like they're the same thing, but the reality is they are two such different sort of asset classes within property or property subsectors. We really think about property or housing as being on a spectrum, a housing continuum, where on one side we have market rate housing, which people in school and I am most familiar with and I live in. On the other side, there's public or government funded housing, which is perhaps what we can think of when we think of social housing. And an example of a building is there. And in the middle, we have social and affordable housing. Coming one step in from market is affordable housing. And the key definition or the key defining characteristic of affordable housing is that rent is set as a percentage of market rent. That can be 75%, it could be 80%. Sometimes it's even higher in some cases. But there is no generally accepted definition of affordability, rather it's a percentage of market. And what that can mean sometimes is housing which is quite unaffordable despite being called this. Coming one step in from the right-hand side of the page is social housing or community housing. And in this type of property, tenants pay up to 30% of their income as rent, plus Commonwealth rental assistance, which, as Casey mentioned, is the model we're going down, and we have gone down in Victoria plus New South Wales. And to give examples of what that looks like, that sort of drops out across a broad portfolio of tenancies. It sort of drops out at high, in the sort of the high 40s, of 45 to 50% of market rent. So in both those investments, we've been fortunate to structure a government top-up payment, which gets you all the way to 100% of market rent, while removing a bunch of the risks that you typically see in property, things like vacancy risk, maintenance risk in some case, obviously credit risk. And tenants have to come from the social housing register in their respective state. So it's sort of a very different asset class to affordable housing. It's much more defined, much more structured, but financially, and has a much higher impact, but financially can mean that you get all the way to 100% of market rent while removing a couple of the risks. And if we can show what good looks like in this sector, I think that'll see a bunch of capital flow into the space, and that could be sort of CIM catalysing broader impact. So specifically, the fund we're looking to set up is a $200 million fund. It's a closed-ended fund with capital calls that will target 8 to 10% per annum, and it's being set up to fund the investments, just like what we've mentioned. So our pipeline of additional properties in Victoria, the New South Wales investment, and a couple of other states where we're in advanced discussion subject to financing. The idea being, as we put together a portfolio, the idea being it'll be a portfolio of very high impact assets. We think at this level of funding and based on current property prices, we'll create somewhere between 800 and 1,000 housing outcomes through the fund, which is incredible, and we're very keen to do. But importantly, financially, as we think about the sole purpose test as an example, creates a very repeatable and relatively high cash yield, as well as some defined assets. So something that really fits well into portfolios and creates that ballast. So if this is of interest, please reach out to ourselves or Channel Capital. Always happy to chat about social and affordable housing more broadly. It's probably the sector we know the most about. So always happy to have a chat about it, either for this fund or more broadly, but please reach out if you can speak. And with that context, that's our presentation done. I might hand back to James to run through any Q&A that might have come through.
Thanks, Matt. Thanks, Casey. Really appreciate it. We do have some questions, and I'll fire them both towards you, and please just nominate who you'd like to speak. But on the first fund, the Impact Fund, we've just had a question come through. What is the current yield and what is the projected yield over the next 1, 3, 5 years? Matt, Casey, if you could answer that, would be great.
We're going to be too polite here. Maybe I'll go first there. So the current yield is just over 4% on the fund. We think that's about right. You should think about that for the next 12 months and ramping up after that. The fund will target a yield of around 5%. It can be higher based on our modelling, but that's obviously a forward-looking statement. We'll see how that plays out over those longer time horizons.
Great. And then I guess in continuing with Fund 1 or the Impact Fund, where are we with the current allocation of capital to projects? If you had any insight, that'd be great.
Yeah, so really covered by that portfolio construction on one of the initial slides we ran through, which we'll send around these materials after the webinar as well, as along with the recording, so people can run through that in detail at their own time. But the sort of 100% of capital is allocated to new projects, of which sort of 76% has been invested to date, and the remainder we expect will be by the end of the year.
Great. Another question that's come through. In July 2023, the SDA price review, and how will that translate into existing investment valuations? Do you have any comments there, Matt or Casey?
Yeah, so specialist disability accommodation prices are reset on a rolling 5-year basis. And this year is one of those rolling periods. So the NDIA, the National Disability Insurance Agency, is currently commissioned a report to reset prices in light of sort of higher building costs, higher land values, and a bunch of other things since the first prices were set 5 years ago. That report's due in the next few weeks. The process has been going on for sort of 6 or 7 months now, which I'm not sure who asked that question, but very, very observant and obviously across the detail. And when the report of the new prices get released, that'll be implemented on the 1st of July. So obviously there's uncertainty, although we're feeling positive about specifically the areas of disability accommodation that we've financed. And that's because we've taken a really tenant-led approach. So funding perhaps previously underserved tenants within SDA. And our hope, and hope this plays out, is that those underserved areas will experience positive price movements to try and encourage more capital to flow into the space. If that does happen, or when the pricing gets reviewed, that's going to be a catalyst under our valuation policy to update our independent valuations of the assets, and that'll flow into NAV as soon as we can.
Great. Well, I guess that kind of feeds into the next question that's on the radar, but I don't know if you want to expand on those comments, but valuation expectation more broadly in the current macro, I guess, climate, and, you know, with rates moving to where they've gone, any kind of comments from the valuers or from your perspective?
Yeah, Casey, do you want me to take that, or do you want to take it?
On a roll, yeah.
So I think disability accommodation is sort of covered by that pricing review. In the case of social housing and specifically apartments, we're definitely seeing a couple of factors going on at the moment. The first is higher rents, which people on this webinar will be familiar with, and that's being driven by a range of factors, sort of tight, strong demand, overseas migration, and perhaps a trend towards a post-COVID trend towards more apartment living, as well as higher rates, which have led some landlords to need high rents. On the supply side, there's definitely been decreased supply of new apartments, and you can sort of see this mechanically when you look at apartments. It takes 4 years to go from a development site to apartments being sold once the site's acquired and permitting happens and construction happens. you can get quite a good forward-looking view of what supply looks like, and that supply is declining year on year, subject to sort of anything changing materially. So we suspect both of those factors are going to be supportive of apartments, inner city, high quality apartments. Obviously, that we'll see how that plays out as in every asset class, but it is perhaps skewed to the upside, as we suspect.
Great. And the final question, and any more, please send them through. But this is more of I guess, a macro and broad question. But what are investors doing in the social housing space, and what you're seeing from the coalface?
Yeah, well, perhaps I'll have a first go at that, and Casey can jump in if there's anything that I miss. I think it really splits between the social and the affordable housing subsectors. In the case of social housing, the investment that we funded last year is the first time private capital funded social housing. So we've now got 400 tenants in the portfolio, and have been watching that for a couple of years, and learned a bunch of lessons in terms of what good looks like in the space, as well as obviously now moving into Sydney and funding social housing there and expecting to go interstate. So that just comes with a bunch of lessons in terms of how you structure things, what the tax outcomes look like, and specifically how you work with a not-for-profit community housing association to give the best experience and think about how supports are funded, etc. In the case of affordable housing, there's probably been more investor activity. So affordable housing, again, to refresh, is where rent is set as a percentage of market rent. And there's been some examples of a few examples of institutional investors going into that space and effectively doing the maths to say rent will be lower, but vacancy risk will be lower, like a demand supply diagram. And if you're happy with the yield that drops out down the bottom, then that works. That sector is also supported by in some cases, local government restrictions and a requirement for new developers to have certain amounts of affordable housing in their new buildings. So we'll definitely see a sort of almost a bifurcation of the market in terms of people focused on that asset class versus people focused on social housing, but definitely more activity towards affordable housing, which is not 100% of our focus.
And Casey, do you have any further comments to add at all?
Just reaffirming that there is a lot of interest in social and affordable housing broadly, but they're often lumped together, and there's in some cases kind of relatively low understanding of the differences and risk profiles of each. And I think that there's definitely interest from the institutional layer of the market, and we're seeing roundtables held by the federal government, for example, off the back of their funding announcements in the last budget. So I think that there will increasingly be more activity and interest from institutional investors in the years to come as the HAF legislation passes the Senate, hopefully in the next couple of months. So yeah, definitely more interest from investors and activity to come, and very grateful to be supported by the investors on the call here who've enabled SIM to build out our track record in social housing, and hopefully that sees us really kind of strategically well placed to take advantage of future government funding opportunities as they come through. And also it's given us the ability, as Matt said, to learn a lot, and we'll be sure to kind of publish those learnings broadly so that capital coming into the sector is done in a really impactful way.
And I think a thoughtful way as well. Well, there aren't any more questions for the call, but I just wanted to say, Casey, Matt, thank you so much for your time today. You'll see some faces on the webinar at the moment, and please reach out if you need any or have any further comments or questions. We will be circulating the presentation to you, and just wanted to say thanks again for your time, and thanks, Matt and Casey, again.
Thanks everyone for today.